2.75%. That's where Bank of Canada's interest rate is at currently. They did a 25 basis point rate cut today. So is that bullish? Is that great? Is it time to buy real estate in Canada? Is it time to buy stocks on the Toronto Stock Exchange? What can we get out of today's rate cut? What can we get out of Tiff Macklem, the head of Bank of Canada? What did he say today that we should focus on for what is to come? Now, this rate cut, this 25 basis point rate cut, if we were in an environment where there was no trade war, we wouldn't have tensions with the US, we wouldn't get also Chinese tariffs. China putting, I don't know if you guys have seen the news, but China put 100% tariffs on Canadian imports as well. If we weren't in that environment and everything was fine, could we see a better environment in terms of the economy? I think yes. But this rate cut comes in, the 25 basis point cut comes in for a reason. And there are telling signs from Macklem telling us that is pain. It is pain that is ahead down the road. Now let's go over a couple of things here that comes out from Macklem during his press conference. So first things first, given we expect tariffs to cause economic weakness, and the fact inflation is close to 2%, we felt the most appropriate course of action was to cut 25 basis points. So the reason they cut interest rate by 25 basis points is not because he's your best friend, not because he likes your dog, your cat, your mother-in-law, or whoever it is. It's because he sees economic weakness coming down, right? We heard Tiff Macklem say in Mississauga, Ontario, talk about that if these tariffs come and they prolong and they happen for a very long time and they're aggressive, we could see Canada have a very hard time bounce back from this. The growth in the GDP would be crushed if we get this scenario. And we have Tiff Macklem reacting to this ahead and doing the 25 basis points because he sees a lot of uncertainty around this trade war and sees pain ahead as Trump continues on his path to get people and get countries to pay them, right? He talks about the reciprocal tariffs that are expected to come April 2nd, right? So it is coming. We already have the 25% tariffs on auto and steel, on steel currently, but we have the tariffs to come on autos on April 2nd, and who knows, probably some more items as well, right? So he goes on to say, uncertainty is making monetary policy more complicated, but I'm confident we will maintain price stability over time for Canadians. So this monetary policy is more complicated. You know, the path, the objective was to maintain price stability, but that has changed with the tariff war, right? We heard about inflation was the issue. Now basically stating that, you know, we'll continue to monitor inflation and do our best. Can't guarantee, you know, what will happen, but now we have to focus on this trade war, right? Which comes down to cutting rates if it were to really weaken the economy. He also mentions not ruling out any unscheduled rate movement if something severe happens suddenly. Okay, so here you go. This line telling you, if something severe happens, just like a recession, a crash, remember COVID time, those emergency rate cuts? He's telling you right here, something severe happens, we will do those emergency rate cuts. So don't be jumping in happiness and in joy, because every time we have emergency rate cuts, what do we see in the past? Just look at history. When we get emergency rate cuts, what happens? The economy crumbles. People lose jobs. The unemployment rate goes up. It's not no assets to the moon, stocks to the moon, real estate to the moon. No. Everything is halted. It comes down and people lose jobs. People are affected by this, right? So that's why, so if something severe happens, we cut aggressively, right? We don't think the revisions to Q1 growth will be that big. Q2 will most likely be weaker than we forecast in January. Do expect there will be some spillover from uncertainty into the housing market. There you go. He just commented on the housing market, right? Generally, he was avoiding that many times in the past. Now he has finally made the comment saying there will be spillover from uncertainty into the housing market. Okay, just look at it. Days on inventory moving up higher. The condos in the Toronto market more showing up. The rents going down. Prices will probably are in some areas going down as well, but will continue to go lower. Right? We're not in good times right now. We are in the pause. We are in an era where the market is on standstill, the economy is on standstill, and eventually those rate cuts are going to come. And no, we're not going to go up. We're gonna see a downward trajectory. We think monetary policy right now is very much in the neutral zone, basically saying that it's not easing, it's not tightening, in a neutral zone, right? And that basically leaves room to cut further lower to ease, right? If inflation were to pick up because of tariffs or what have you, money printing and so on, they can go also above the neutral zone to decide to tighten. But I don't think that's going to happen first. I feel the next step is more rate cuts away from the neutral zone, going down because of the severity, because of the uncertainty, because of the recession, right? Diversity has served Bank of Canada very well. And let's see what else he has mentioned here. He also mentions that this is coming from Rogers. What we're hearing from Canadians is that sentiment has turned quite sharply, okay? So Canadians are feeling the pain. Canadians are saving more, spending less, and we will have a forecast of that at our next meeting. A recession will have a lot to do with what the U.S. does on trade policy. So not saying that, recession is coming for sure, but it hinges on what the U.S. does. Well, April 2nd, we know we have reciprocal tariffs coming in. Let's see if that comes through. We did not seriously consider a cut of 50 basis points. Why? Because they'll save that for those emergency rate cuts. They'll not do 50, they'll probably do 75 and maybe even more, right? The hard data so far looks still good. Yes, nothing has crumbled just yet until we get the event that will make it crumble. This is a very fluid situation. There is still a lot of unpredictability, right? BMO, Bank of Montreal, says our core assumption is that Canada will face some serious tariffs of an extended period of time, that growth dampening aspects of the trade war will ultimately outweigh the upside inflationary impact, keeping bank in easing mode. So basically they're telling you that they see pain ahead. Inflation, sure, may tick up due to inflation, but the pain will be so bad that it will actually reverse the inflation and bring it lower. As long as the pressure on tariffs remains in place, Bank of Canada should keep its dovish bias. This is coming from TD. TD continues to say we have the overnight rate setting at 2.25% by June, but we see limitations in going further due to the delicate balance in managing inflation expectations. So TD's unsure. Okay, we got inflation here, we've got pain ahead now, but BMO says the pain is probably going to be more severe, thus bringing the inflation lower. And yes, BMO has the right idea. When you look at past recessions and history, every time you get that severe recession, it does bring inflation down, thus keeping Bank of Canada in the easing mode, which eventually will bring back inflation. Now, some people argue we could get double-digit mortgage rates right after this. We could get, inflation ticking up higher. We'll talk about that when that time comes, right? If we get COVID-style scenario where you have COVID-style kind of recession where you have the shortages in supply plus the increase in money printing, then yes, for sure, we will see that same scenario, interest rates skyrocketing again, and inflation skyrocketing as well due due to those situations, right? So anyways, let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers. Bye.